All right, welcome to today's video where we're going to cover a long-short equity trade idea and essentially how hedge funds are able to make money and profit even when they're wrong or even slightly wrong. So the agenda for today is first of all the regime, right? So we've been breaking down the PMI themes in both manufacturing and services last week, and that led us to a few industries that are breaking out today. Now, there's also a coming up thematic area of the market called the halo trade, and this is one backed by Goldman Sachs. I started talking about it in October of last year, and of course it hasn't gotten the attention it deserves because of the momentum and high growth in the AI semiconductor memory trade, right? But essentially halo means high assets, low obsolescence, and this is quietly crushing the asset light area of the market, which is essentially the AI momentum trade. So these are high quality balance sheets, high asset based balance sheets in real economy businesses. Now, apart from that theme, we have to follow the money trail. And the money trail is essentially the $1 trillion capex backing the data center build out and the AI infrastructure build out. Now, all of that, or most of it, runs on steel. And Section 232 tariffs that kicked in on Liberation Day last year have pretty much handed the pricing power to U.S. metal makers, to U.S. steel makers, right? So based on that, we have a tiebreaker when it comes to bottlenecks and where they really are. And Fed readings for capacity utilization shows us that it's not just the metals themselves. They're not just the steel prices and steel bottlenecks, but rather the fabricated products that come from the raw materials. So it's not the same to say steel prices and raw steel than to say steel fabricated towards the automotive industry, steel fabricated toward the data center infrastructure, right? So like hot rolled coil or flat sheet steel and things like that are really the bottleneck right now. So that leads us to companies that make those fabricated products rather than just deliver the raw steel themselves. That leads us to the trade idea itself, right? So we have one long, one short inside the same industry. This is market neutral by nature. So we don't care what the market does. We don't care about the AI trade and what it does next because this market neutral play will print by itself. And most especially, or more importantly, it'll print and deliver a profit even if CapEx slows, speeds up, or does nothing over the next quarter. That is the hedge fund secret. Now, the trade that nobody's talking about, or at least a few people are talking about, is the halo trade, as I mentioned. This is high assets, low obsolescence. And it matters a lot today because 62% of the tech sector is now trading in a bear market, which means 20% off the highs. And 80% of them are all in correction territory, which is 10% off the high. So markets are correcting for future growth assumptions, bringing them back into a more realistic sense, while 62% of these names are now in a bear market saying, well, that picture for the future has completely changed. So we're past correcting and we're now adjusting valuations to where they should be. That matters because the halo trade is essentially the mirror image. It is the antithesis to the memory and semiconductor trade because it holds value, quality, and breadth as the factors that act as headwinds or rather tailwinds for this trade. So while the AI trade is all momentum and growth, the halo trade is the mirror image for value, quality, and breadth. And that matters in the sort of rotations that we've been seeing in the S&P 500. By the way, if you read the morning digest inside the Offside newsletter, we track these rotations and price movements every single morning. So that leads you in the leniency for the day into whether we're going back into concentration for the AI trade or we're switching back into rotation for the halo trade and the real economy names. Now, the most important factor rather in this entire rotation is software. And if you've been reading the Offside newsletter, you understand that for every $1 that goes long the semiconductor and memory trade, roughly 30 cents go short software as a hedge. Now that matters because as more momentum, as more people chase the AI trade, more of these prime brokers, more of these bankers have to go short software to hedge out their books. So what happens when capex normalizes or even slows down, or the South Korean crisis kicks in? If you read that paper I wrote, what happens then, right? I think the rotation goes back into software, and that could be one of the best ways to play the entire AI trade. But that's the topic for another video and another newsletter I wrote about. So today we're going to get into the second best trade. I think it's the Hello trade, to be honest with you. So now let's go back to following the money, right? So the $1 trillion build and how it runs on steel. So since Liberation Day, like I mentioned, Section 232 tariffs came in and created a power vacuum for U.S. steelmakers and U.S. metal producers. Now here's where the build out side of the equation comes in. So we have hyperscalers, Nvidia, and other big players pouring over $1 trillion into data centers and fab build outs in the United States. Now all that steel that's needed to utilize that $1 trillion capex spending is not going to come from overseas because, first of all, the build out is already expensive. We have already poured all of the hyperscaler free cash flow into this project, and there aren't any timelines as far as when a positive return on investment is expected. Now, with Microsoft pulling out of the AI spending wave, with Meta pulling out, Uber pulling out, and more companies pulling out and spending less on tokens, that timeline to a positive ROI widens out and goes further back or away into the future. So what happens is these companies are not going to build the data centers based on more expensive foreign steel due to the tariffs. So they have to look inward. They have to look domestically. And I think this is where U.S. steel players will see a net benefit. But not all of them. It has to be specifically the fabricated products, as I mentioned. And essentially, 90% of data center materials are steel. You have steel, iron, aluminum, all of these materials, but 90% are made up from steel, which is why hot rolled coil steel prices have gone up since September of last year. So they're pushing up to roughly 35% increments since fourth quarter of 2025. I don't see it slowing down anytime soon, especially as you see the real economy halo trade start to recover and more manufacturing activity comes in through the PMIs. So we have a double tailwind here through real economy plays as well as the data center build out. So the Section 232 tariffs are going to keep those prices on the more expensive side. Demand is going to keep it on the more expensive side. But again, not every steel player wins. And let's get back into primary metals now. Okay, so new orders, if you watch the PMI breakdown, are breaking out. So new orders equal demand for primary metals in this case. And we've had an entire quarter, so 3 consecutive months of expansion, which means the odds of an EPS beat or an EPS increment for the next quarter are on the rise as well. When you have 3 consecutive months of increase in demand, chances are a lot of the vital players in the primary metals industry, which include steel, are going to beat their earnings expectations. And that's where, quite honestly, we can make a lot of money. And the bottleneck, again, is not steel, is what you make from it. So when you look at capacity utilization readings from the Fed, you have primary metals, so like raw steel, raw iron, and all these metals. They're operating at 74% capacity, which is hot. I mean, anything above 72% is considered on the hotter side, and increasing the pricing and margin dynamics for anybody that plays within that industry. However, it's not really the hottest one. The hotter one at 83% is fabricated metals. So fabricated metals are really showing the bottlenecks, and it makes sense when you increase the demand for data centers, for automotive industry applications and everything else. It takes a while to turn raw steel into the fabricated products that is used for. So that's where we should start looking into, because we have increasing demand, as we saw in the new orders, for 3 consecutive months. And then we have the bottlenecks increasing the pricing and margin dynamics for fabricated products. So of course, the odds are really looking, really good for those players in the fabricated metal products for the next quarter. Now, the 72% rule that I just mentioned, well, we have what's priced in and what's not priced in. So, again, anything above 72% means it's getting hot. And when you look at computer and electronic products, which include memory prices, have been operating at 80% or more for the past 6 months. So right now you're seeing that dynamic in companies like Micron, Samsung, SK Hynix, SanDisk, even Apple and Microsoft have said that they're going to increase the hardware prices based on these memory spikes. That applies to Best Buy and other retailers that are pretty much saying the guidance is going to be a lot different now based on these hardware price increments. So something to watch out for as a separate trade idea. But for now, let's focus on this. The motor vehicle and parts industry have been operating recently, as of May, at 71.5% capacity, right? 3 months ago, that was trading at or operating at 63%, which means the one that is really seeing the delta, the one that's operating at a hotter and hotter and hotter pace, is the automotive industry. So what's priced in already, I would say, is the memory increments, is the computer electronics industry. That's been operating at a hotter pace for a while now. I don't think there's a lot of upside left that is unpriced. On the other hand, though, you have motor vehicles starting to heat up from 60s to the 70s percentage points in the capacity utilization reading. So, of course, that is not priced in yet. And as we reach 72 and above next month, potentially, I think the market might start paying more attention to that area and start saying, well, the bottlenecks are already in the fabricated metal products coming from steel. The orders are coming in. And now new bottlenecks are forming that are not priced into the automotive industry as compared to the computer industry that is well priced in at this point. So you have in this setup that I just mentioned, two steel players. And there's one huge valuation gap. So on the one side, you have a premium name in terms of forward PE multiples. So I begin to question why the market, why participants are willing to overpay for that name. And the reason is the EPS growth, right? So markets are expecting over 100% EPS growth for the next 12 months. That's what Wall Street thinks. And this one is a steel fabricated products player. This one is exposed to data center orders and also automotive orders, right? So you have two industries where this company is diversified into. They didn't bet the entire ranch on data center demand. Rather, they kept about 50% of demand toward data centers and 50% toward the automotive industry. And as we saw from the capacity utilization readings, essentially the computer industry, the data center industry, all of that growth is already priced in, which means there's a lot more downside than there is upside. If you look at the automotive industry, there's a lot more upside than there is downside based on what's already been priced in and what's not priced in yet. So I like this name. I think the premium is justified based on the EPS growth. And by default, I think the EPS growth is justified based on the bottlenecks that are forming, based on the demand that is forming in the diversified revenue streams. Then on the other side, for the short leg of this trade, you have a discounted name. So it trades at a discount in the forward PE basis. And I think that discount is justified because analysts expect 9% EPS growth only. So you have 100% growth on one side, 9% growth on the other side. And the reason they're expecting so little is because this steel company bet it all on data centers. And now data centers are not getting new projects, right? So this is the big difference maker here. This discounted name plays in the raw steel industry. It's not a fabricated steel products name, right? So which means these data center builders, they're asking for steel, then they turn it into whatever they need it for to build out the data centers. So as steel doesn't operate in a hot capacity reading, as new data center projects are not coming in, rather the CapEx is slowing already. You see Amazon saying they won't finance any more CapEx for this year, maybe next year. But the shakiness is starting to come in as far as new data center projects. This company bet it all on data centers, which is why EPS projections are coming off so low into 9%. So without getting too much into it, you have 100% growth into one side, diversified revenues into an area that is becoming hotter and hotter and hotter. And then you have 9% growth, discounted, justified, right? A discounted multiple that is justified because they bet it all on an area that is slowing down. Now, this is the trade structure that is going to be available for premium members. I want to remind you that prices are going up on July 17th, so take advantage and lock in today's rate. You'll be grandfathered in for as long as you remain a subscriber, so don't need to worry there. So on the long side, again, we have the fabricators, so the fabricated steel products provider for both data centers and the automotive industry, which means whether AI CapEx continues and more data center demand comes in, this name is set up to beat the next quarter. And also, if CapEx slows, if new data center projects slow down, the automotive demand that is already showing in the capacity utilization readings and the PMI readings also set this up to beat the next quarter. Now, on the short side, this one is all in on data centers, all in. The growth is already priced in and it's already expected to slow down, which means the odds of them beating the quarter is already too, they're so thin that I would say this is a great short play. And without getting too much into it, even if AI CapEx continues and data center demand continues, the growth is already priced in. That demand has well beyond been priced in. So the odds of them missing the quarter and going down are pretty high. So fundamentally and technically, these two look like a great play. Now, these are the reasons why I think it'll win whether CapEx holds or cracks. On the CapEx holding scenario here, we have the long side of the equation beating big on both the data center and automotive demand. Now, the short will still rally, I believe. I'm not saying if data center demand pops that this stock will automatically go down because they did bet it all on data centers. What I am saying is that most of the valuation priced in all of this new growth already. And you see examples like Micron, like Samsung, beating both on revenue and earnings and still coming off because expectations were too high compared to what was left to be priced into the industry. So again, the spread widens and you get paid. If CapEx slows, then you have quite the opposite. You have the short side of the trade collapsing and paying you on the CapEx cut, on the data center demand collapsing, and everything that I just mentioned. Then the long should by default go down, but then the market realizes there's a lot more diversification to the EPS, to the revenue growth, and new demand for these automotive orders. Now, keep in mind, Section 232 also explains or states that vehicles assembled inside the U.S. are going to have a tax credit or less of a tariff as well, which means if any demand for vehicles comes in, is going to come through the U.S. If any steel demand comes in, is going to come through the U.S., especially as we have a more price-sensitive, a more budget-sensitive consumer and thinning margins for the automotive players. So again, I think the long wins on either scenario, and I think the short is going to pay off big in the CapEx slowing scenario and give us a small loss or a controlled, contained loss if CapEx continues, but it's going to be more than offset by the long side of this trade. Now, the smart money is already in both of these legs. If you look at the options data and options flow, on the long side, or the long candidate that we picked in this trade, options show already 100% upside potential for July alone. So the options open interest and volume show that by the end of July, these traders expect 100% upside or 100% price action appreciation on the stock. And then on the short side, there's a very specific bearish call spread scenario. So there's a lot of calls being shorted at 150 strike to finance longs at 240 strike. So what this means is you short 150 strike, that premium you collect, you use to buy a lot cheaper calls for 240 strike. So what happens is the stock pops, the 150s that finance the longs will lose, but then the 240s plus the long stock wins. So essentially, you break even at the 240 strike or more. If the stock drops, then the 150s decay a lot faster. And since you got a lot more premium for them, then you profit off of that. Then you can pretty much close out the 240 longs and hedge out the long stock that you still have while you unwind that trade. So essentially, the smart money or options traders, whatever you want to call them, are already behind this trade on both sides, which acts as a confirmation on my end and on this idea as well. So as of right now, you have the thesis, but premium members have the trade. So what you got here today from me and from the written version of this newsletter, which I've linked in the description below, you have the full halo plus the steel framework here. You have the three aha moments from steel prices going up, capacity utilization, and the forward PE gap between the fabricated products and the raw steel providers. You have the structure of why this trade will pay either way. Whatever happens to CapEx during earnings season, whatever happens to the data center demand moving forward, I think this pays off. And then you also have a 72% unpriced auto kicker for the long side of this trade. Now, behind the paywall, you will get the two tickers, the long and the short. You will have the enter price, the targets, and the stop levels, the exact hedge ratio and structure that I'm giving out, and a full write-up shipping out this week. In fact, earlier today, I sent out my Lululemon long trade thesis, as well as an option sleeve for on holding to mitigate the timing risk for the Lululemon turnaround trade. So of course, these are more institutional ways to structure a trade. There are more simple plays like my Adobe deep dive that I've also linked in the description below. But if you are more into professional trading and structuring, then essentially this is what you have. And coming up in the newsletter and on the YouTube channel, we're going to cover how Goldman says that we're now in an earnings bubble. This is a really in-depth topic, I would say, because everybody says we're not in a valuation bubble, which I agree. I mean, price to earnings multiples, price to anything multiples are not at bubble territory. But when you look at earnings quality and the level of accruals or non-cash income are at all-time highs. So if you discern all of these earnings and you become just a little bit stricter on the quality of these earnings, then multiples could double or triple from here. So again, we're not in an earnings bubble, but we're not in a valuation bubble, but we are in an earnings bubble. And if you become stricter around the earnings, then we very, very quickly get to a valuation bubble. But either way, we're gonna cover that into the next video and follow up newsletters. So make sure you sign up. I'll leave all the links below this video. Again, I hope you enjoyed this, got a lot of value out of it. Feel free to reach out to the emails and comment below with any questions. Good luck, everyone, and I'll see you on the next one.